And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart, welcoming you here for a special Wednesday live stream with Jonathan Wellum, head of one of the financial advisors that Thoughtful Money endorses. Jonathan runs ROCKLINC Partners up in Canada. ROCKLINC is Thoughtful Money's endorsed Canadian advisor. Jonathan is also a very experienced investor in general, very much from a Warren Buffett style, but very much experienced in investing in the precious metals. And on the day we're talking, we seem to be right in the thick, Jonathan, of a breakout in gold and silver. So it's actually a very exciting time. Folks, it's early my day. That's why you're getting the slick back shower hair. Hopefully it'll dry as we talk here. But anyways, Jonathan, great to see you.
Great to be on the program again and see you and talk with the listeners. That's wonderful.
All right. Well, look, Jonathan, why don't we just get right to the meat of it here? So for the longtime precious metals investors that are watching, they've got to be feeling pretty chipper today. Gold is, it's been on a string of breakouts over the recent past trading days. But last check, it was well above 3,600 an ounce. It actually surprises me to have that word come out of my mouth. That gold has moved very far over the past 2 years. So that's an all-time high for gold. And by the way, this is gold future, the gold futures price I'm mentioning here. The silver futures broke above $40 an ounce, I think 2 trading days ago, and are now pushing their way towards $42 an ounce at the moment. And I know, from past conversations with you, Jonathan, we had talked about silver really trying to bust through $35 an ounce. And then once it did, wouldn't really have a lot of resistance above it until it got up near around 50 or so an ounce. And I think we're maybe sort of seeing evidence of that in real time here. So anyways, I will take a beat, but as someone who's been investing in this space for a long time, who I think has been positioning his client capital for a moment like this, give me a sense of how you're reading the tape right now.
Yes. Back when I set up ROCKLINC after being in the mutual fund industry for almost 20 years, I set up ROCKLINC and we took basically a 15% position or so in precious metals securities. A lot of them, the royalty companies. We like the Francos, the Wheatons, the Royal Gold, Sandstorm, et cetera. And so we built positions there, and then we did very well. Of course, as you know, in 2011, things jumped up, and then they went back down again. And then in 2016, we got a bit of a run, and then back down again, and then COVID and so forth. But our view, again, we're value investors, is we're looking at the macro economic environment, and we're seeing everything that the different folks that you have on the program are speaking about in terms of the debt issues, potential debt deflation. You've got, again, governments just running out of control in terms of deficits. All of those factors, fiat currency under pressure. The numbers are horrific in terms of loss of purchasing power over the last number of decades, not just the last couple of years. And so our view is you have to be there and you try to buy the best companies that are well run, know how to invest in the sector, know how to reinvest, and so forth. And so that's what we've done. And we're very happy now with some of the positions. We've seen significant expansion in terms of the price appreciation, and we're happy to see that. But our view is that we're not going to get out of our monetary and fiscal situations in an easy manner. It's going to be painful, and therefore you need to be in these spaces and you want to own some of the best companies. And for some people, they can dabble and maybe do a little bit of speculation, because when things start to run, as you know, they can really take off. But again, you want to be wise and you want to be prudent and careful so that you don't throw money down the toilet, so to speak, and you make sure you're buying companies with good managers with good assets in reasonable countries.
All right. Well, look, I'm going to talk about any and all of that today, Jonathan. And then we'll also, folks, we will halfway through, I'll do my best to open this up to Q&A from the live audience, so you can ask questions there in the live stream, and I'll start pulling them in. But Jonathan, from our many previous conversations over the years, I well understand your kind of macro reasons for getting into this space, and you mentioned a few of them there. I'm curious what your thoughts are on kind of what is instigating the move right now in the precious metals. Is it more just sort of true price discovery starting to happen, where the world is enough investors are starting to wake up to the macro issues that you talked about and are saying, you know what, I actually I want to get me some protection here and some exposure to this asset class. And we just sort of hit the tipping point and the price is starting to really move. Because as you and I have talked in the past too, these markets, gold, especially silver, they're not that big relative to the general stock market or the general bond market. So is it more just sort of hitting the natural inflection point of awareness and interest, or, you know, is there something that's really driving this? Either something big like, you know, China is doing a ton of fiscal rescue stimulus this year. Is that wave just bleeding into things? Is it fear of the U.S. tariffs and the fact that Doge really didn't seem to do much and that we're just going to have runaway fiscal deficits forever? Is it, or is it more like maybe something's breaking and the rush to the precious metals is the early smart money saying, hey, we know that there's something going on the rest of the world doesn't know yet, and we're trying to position in advance. And I don't know, you know, that requires a fair amount of speculation, but if we just sort of look over at the UK market and we see the yields in UK gilts blowing out, that seems to be a sign that somewhere in the world something might be breaking. So I'm curious, do you have a strong opinion one way or the other?
Yeah, I think it's really all of the above. I mean, the fact yeah, I think the factors you mentioned, they're all coming together. I mean, you had a wonderful guest, Lawrence Lepard. I listened to that just recently. You just had that just in the last couple of days. Yeah. And I mean, he's firing at all cylinders. I mean, you talk about the problems, and Lacey Hunt too. I mean, he's dealt with some of these issues, but at the end of the day, the debts have just piled up so high and the deficits just keep rolling and no one seems to care. But the funding of these debts and deficits is impossible at the current interest rate level. And so we are now having to really expand the money supply in order to cover the interest payments. That's where we're at. So you put that along with the tariffs and the sort of reordering of trading arrangements in the world, China and the problems that they have, the central banks concerned about each other so that they're buying up a lot of gold. I mean, the central banks have added a lot of gold to their reserves over the last little while. And so you put all of that together along with demographics, a slowdown with all of this debt. How are we going to get out of the debt cycle that we're in? And I think people are going, we need to protect ourselves and our purchasing power. Our purchasing power is being eroded at an incredible rate. I mean, I run the numbers over the last 50 years and you look at how much we've lost in terms of purchasing power. It's shocking. And the government statistics are clearly inadequate and inaccurate in terms of gauging the kind of loss of purchasing power. So I think with the Bitcoin phenomenon, also some of the cryptocurrencies, all of that is just everything's pointing in the direction of protect yourself. That this is not going to be a pretty picture as we try to extricate ourselves from the mess that has been building now for a number of decades. I mean, as you know, we solved the great financial debt crisis of 2008 and 2009 with basically increasing the debt levels by 50 to 70%. I mean, it's really quite
which wasn't really a solution. It was just a kicking the can, right?
Yeah. And so I think all of those are coming together and people are starting to say, hey, we need to protect our assets. But as you know, and as you've pointed out, the market is very small. It's under-owned. I mean, we now have a quarter of our assets in gold, silver, and a little bit in uranium and so forth. Some of the areas I think will benefit from the increasing demand in energy. Because
sorry to interrupt, but is that because you bought more or just because that position size has appreciated so much recently?
Both. We've bought more. We've topped up positions over the last year or two. I mean, I said at the outset that we started off with about 15% in our ROCKLINC portfolios, but that was back 2010. And over the years, we've just let it crawl up slowly. Recently, I just ran the numbers before doing this program, and we're up to a quarter of our assets and 30% in our ROCKLINC Partners fund, which we use for some of our clients. That's through growth and also just putting more positions on the books because we think that we are close to something that's going to get a little more painful from a monetary perspective.
Okay. Let me ask you this question. Grant Williams, you may remember, famously wrote a piece 10 years ago or so called Gold, No One Cares. And it was written for guys like us who thought about and worried about all the things that you've mentioned, Jonathan, and why that meant owning gold was a wise thing to do. But gold just sort of sat there, right? It had a bunch of years after the price spike came down in 2012 or whenever it was, and really just sort of went nowhere for a long period of time. And Grant basically said, look, you're probably very right on your thesis, but it doesn't matter if nobody cares, right? And since then, we've seen different segments start to care in recent years. We saw central banks, actually really the first ones, started to care. And they started buying gold now at rates higher than they've ever bought before. We saw the Eastern speculator wake up and start to care. And for the past number of years, they've been very happy to buy gold from the West at, low prices. We have, I think, waited for the moment when the Western investor was going to wake up and start to care. And I've been asking people like you, Jonathan, over the past year as gold has started to move, hey, are we at that stage yet? And generally the answer I've gotten is not really yet. People were looking at outflows from GLD and things like that. Are we at the point now where the Western investors caring? Is that part of what's bringing this up? Or even if not, is what's happening right now enough to wake up the Western investor? Because the Western investor, at the end of the day, loves momentum, right? Wall Street has not been a huge fan of gold, but it's more of a fan of anything that's got good price momentum behind it. Do you think the Western investor is now going to be jumping in, or are they already getting in?
I think they're starting to get in. I think Costco is interesting. I mean, we all know that Costco started selling gold in their facilities, and it went very quickly. And I think that was a bit of a tip of the iceberg, sort of just telling us that actually there's more demand out there than you think. Now, talking to the retail investor, which I do all day long because that's the business I'm in, and maybe a little biased because people coming to our organization know that we're value investors and we are open to owning gold and silver. But a lot of the professional advisors, and I'm speaking here in Canada, they're largely controlled by the big banks up here. They don't really promote silver and gold and precious metals holding. They say they poo-hoo it. It's not really all that interesting. I think the retail investors is looking through their advisor and they're looking at the market and they're smarter and they're starting to say, no, we need to add this. We've seen the cryptocurrency phenomenon also, and we need an alternative to fiat currency. Our purchasing power is being eroded at a brutal rate. And we can't afford to buy homes. Our the price of food's gone up, insurance costs, all of these things are skyrocketing. So I think it is starting to penetrate the retail market, and the retail market is running around a lot of the advisors because, again, I still see the professional advisors not all that excited about it. But this is an area, as you talked with your introduction there, Adam. You have to be patient. And so we own this for a long time. We've done okay in it because we own the royalty companies and they could make money even in a sideways market. But it's one of those things that, from my perspective, if you're a disciplined investor, you will make a lot of your returns in short periods of time, but you have to be there and you have to be there for the right reasons. Mm-hmm. You don't know when it's going to occur. I mean, I'm not a short-term market timer, but we were building positions because we could see that eventually payday is coming. You cannot avoid what our governments have been doing the last number of years. They've been imposing, again, tremendous damage on the financial system and consumers and so forth with a lot of debt binges. So you have to be there, you have to be disciplined. And then when it takes off, you really are obviously happy about that. But now the question becomes, how high can it go? And when do we take some profits off the table and things like that? That's the other challenge that comes into it when you do well.
Well, you anticipated my next question. So, well, first off, I just want to underscore, we've talked many times over the past years about how in your precious metals positions, I think in particular the miners, they move so fast and furiously when they move that if you're not in them, by the time you notice they're making the move, the big money's already been made. And so it's just one of those things that we've said, hey, look, you have to have a foundational position so that you're in it when that move happens. And I think people are getting that lesson in real time right now. I'm seeing people in the live chat here sort of trade stories about the returns that they've gotten on some of their miners, and I'm seeing some 100+% percentages there. So I guess the question for you, look, if you have any price targets, would love to hear them. I don't know if you're in the business of making price targets on the precious metals, but maybe more generally, given that this move has started, do you think we're just in the early innings of where this is likely headed, or was this like going from a stationary start to a sprint, but you expect it to end soon?
I'm looking at the economic situation, and that as long as they continue to run up the deficits, as long as the debt continues to grow, as long as we're having again the trade wars going on around the world, as long as the the BRICS countries and so forth are trying their best to use U.S. dollars less often and come up with alternatives, and people don't trust each other, and therefore collateral becomes more important in our currencies, then I think that the trend continues. So I think that we are, I'd say, if you're going to use a baseball analogy, I guess I'd say maybe third inning or something like that, third, fourth.
Okay.
But I think we've got a lot more runway. I do think if you're an investor and you've done exceptionally well, you should look at your asset allocation. How much percentage of your assets do you really want to have in silver and gold? And be careful if that starts running up against incredibly high levels. You might want to just take some money off the table. You might also, again, take some profits off of companies that are larger, more stable, more predictable in terms of the business, and then look for some really good exploration companies where you can make a little more upside, but you're using profits then, and you can take advantage of some really significant moves on some of those companies. But again, look at the management, talk to advisors, talk to other, know who else is invested in these companies. I think there's going to be some great opportunities coming forward, but again, do it in a disciplined manner and keep an eye on the overall weightings and what you can afford to lose, or how much volatility you can take.
Okay, I want to ask you about some specific sectors of the precious metals market, or maybe even some specific companies. But first, there's kind of two ways capital could flow into this space. One is fear, right? Fear over the things that you mentioned, Jonathan. And I don't doubt that maybe that will be the main driver over time. If we really start seeing a return to more visible, rising inflation. I mean, prices still aren't fun right now, but they're not rising like they were when we had 9% CPI, right? But will at some point people just say, look, I'm like you see in developing countries like Argentina or whatever, where it's like they've been through hyperinflation before, and you get your paycheck and first thing you do is run to spend it because you know that those pesos are going to be half as valuable tomorrow, right? We're not at that part of the story yet. And I do wonder if before we potentially get to that part of the story, the driver might be greed. Where, as I mentioned earlier, Wall Street loves a party where it can make money in a short period of time. So it's always looking for an industry that's catching fire. And again, I would say the mining space has been quite under-owned, or at least under-followed by Wall Street. I mean, a lot of Wall Street firms got rid of their mining analysts years ago. Like, I think they're having to scramble to find people that actually understand these companies now. So if Wall Street starts to get excited about this, especially the mining space, it's tiny. I mean, tiny. I think you put all the companies together and you get like $700 or $800 billion. I think that's the entire sector, where you take the top five, of the Magnificent Seven, and they're like over 15 trillion or something like that. So you don't need that much money to say, you know what? We've had this massive AI trade. Maybe it's cooling off. Wow, the mining complex is catching fire. Yeah, maybe I'll put a little bit in there, right? That could double the space of the mining sector almost overnight. So what kind of role do you think greed could play here if Wall Street really wakes up?
A massive one. I mean, the market is driven by fear and greed. And I think greed is already probably starting to come in at this point. People are looking at a lot of the companies in terms of opportunities, and that will, I think, have a massive impact on the marketplace. When things start to move, again, it's fear of missing out. Your neighbor's doing well in his silver stocks or his gold stocks. Why aren't I in there? I mean, I'm already hearing people talk about it, just, not just in our office and with our clients, but just out in the street when you're meeting people who aren't in the business. So just just up in Northern Ontario recently, and that's what's top of mind. That's what people are starting to talk about. And
Really?
so, yeah,
Interesting.
so I think,
Just because I've heard it amongst my, friends and peers who follow the gold market. Hey, good days are finally here, right? I haven't heard the average guy in the street say like, oh, I got to get me a mining stock yet. Now, maybe I'm just not talking to the right people, but I'm not sure we're at that level of public awareness yet.
yeah, I mean, it certainly could get much
It could
broader.
be.
Yeah, could get much broader, no question about that. But you are hearing people talk about it. Now, I have back in 2015, I must admit, I personalized my license plate on my sports car, and it says "Buy Gold." Okay, and so I have the odd person drive up alongside me, and those I forget. Of course, I'm driving with that plate on. They'll say, "How much gold should I buy?" And they'll yell at me. And then I realize that they're looking for some financial advice just on the highway. So there you go. But yeah.
Okay. Are you getting more people noticing your license plate now?
Yes, absolutely. This year, this summer, I've had I only drive in the summertime, but I've had a number of people put thumbs up and a few things like that. And so I know that's what they're making reference to. Yeah.
Okay. All right. It's going to be disappointing when it's an attractive woman doing it, and then you realize she's talking about your license plate and not you. All right. So in terms of opportunity right now, where do you think the greatest opportunity lies? Does it lie in the metals? Does it lie in the miners? The miners have historically been a more levered play, although silver, was really well behind gold. And so we had talked about silver maybe having some of the best potential here to play catch up, and it kind of is in real time. So I guess let me ask that question, and then I want to get into the mining space where you see the opportunity more in the miners versus, streamers, development, exploration, that type of thing.
Yeah, well, with the streamers, which we've owned through the whole piece, and we have our largest position still in the streamers, they have done very well, and they are trading, some of them at 2.5 times net asset value, which is quite high. And so I think if you own the Franco and Wheaton, for example, and even Royal Gold, which is now taking out Sandstorm, if everything goes according to plan, then you probably will move along with the price of gold with a little bit of leverage to it. I don't think that, again, the moves up can be incredibly dramatic at this point. They can still do very well, but they're already trading at reasonably high valuations. So what we did is we started to go downstream on even the royalty companies and buy some of the smaller ones that were trading at lower net asset value multiples. So Cisco Royalties, Gold Royalty, GROY, a few of those, but those also now have done very well. I mean, our GROY position has almost tripled this year. And so that's just year to date. And so people are waking up and they're searching through and they're trying to filter through what are some of the great companies that were just overlooked. They were smaller market caps, they were overlooked. So I think that's taking place. So I think the next move would be actually to look at quality miners. And in that case, I think I think everybody agrees that if silver does continue to move, it's going to be explosive, and the silver miners will be quite the ride. But again, trying to find good names, solid names in good jurisdictions will be the key. Or buying, we do with some of our clients, we don't do this extensively, but we'll buy, say, the Sprott, silver miners, and they will handpick a handful of them for you so that you don't have to be precisely wrong. You want to be approximately right.
Right.
You got to make sure that you get a good lift. So I think that's where the next play will be, the miners, and going down the mid-size and some of the smaller ones that have good deposits. They're well funded and they're run by exceptionally good people, and then you can make some good money there.
Okay. Let me ask you about a couple of specific stocks. One, I want to thank you. I think at the beginning of the year, we had a conversation, can't remember if it was on air or not, but where you recommended looking into gold royalty. And as you said, that's done really well. In fact, that was offering warrants as well, which I think have done even better than the underlying stock itself. Sure wish I'd bought a lot more. But it can't complain at all with the returns that it's had so far. I've also I posted about this publicly. I have one of the miners that I'd been invested in for the past couple of years. Last check, I think it was up 1,800%, 1,800%. And look, I mean, returns like that are just amazing. Again, I wish I'd put a lot more into it. I only put a couple of grand, but even at that return, it's nice, right? So, I mentioned that just to show we've been talking about the potential of this space when it catches fire. And now we're getting evidence of what really happens. And I should definitely also be really transparent. My portfolio has a long history of a lot of mining stocks that blew up, went nowhere, lost a ton of money. So I'm not trying to portray here that I'm some master investor. But what's nice about this space is, your downside is limited to zero in these companies, where the upside is kind of unlimited. And when the space really catches fire, your winners can make up for an awful lot of losers. Yeah, you're nodding as I'm saying this. I'll let you chime in.
Well, they're incredibly asymmetric returns. So you're quite right. You can, again, 10 baggers, 20 baggers on the upside. You can only lose 100% of your money, but you can make multiples on the upside. So I think that is the game that you play. But I think every time you allocate money, you need to be looking at who's running the company, what jurisdiction they're in, how well funded they are, and so forth. Be very, very careful, because I think it was Rick Rule that pointed this out, and Rick is fantastic in this space, and I certainly stand on his shoulders whenever I can. He says 95% of the miners that trade on the venture exchange are worth less than zero, right? And so again, it's really being careful to ferret out the better companies, and I think to that extent, it's probably better to go mid-sized companies if you're not sure. If you're just gambling, don't do that, please. You need to invest with knowledge, and you need to have some base knowledge if you're going to go into these companies. It's probably better to go into some of the mid-sized ones that are already producing, making money, don't need to come back to the trough in terms of raising capital. But they're starting to produce more, and their production is growing, and they've got some really good ore deposits that they can take advantage of. And then that increasing production, along with the increasing price of gold, silver, the different resources, will give you a tremendous ride, but it's much more predictable, and you won't lose money. So again, you got to be very, very careful in terms of where you're investing. Otherwise, the worst thing is the price takes off and you don't make any money. That's very frustrating. So you want to be careful.
So I'm just going to pull up this comment here by this user S Bain here. It says, don't try to pick specific miners if you're not an expert in that field. The gold mining ETFs will do just fine. So you're nodding, and this is advice that we've given a lot on this channel, which is, look, highly volatile space. Like I said, it's been a widowmaker for many years. So even though we're having our moment in the sun right now, doesn't mean it couldn't go back to being a widowmaker. And so if you don't have experience in this space, it's much safer just to go for the beta, right? Which is just what's the return of the average return of the sector, right? So just buy one of the big ETFs, GLD, whatever, and just capture the beta that way. Now, if you want to try to capture the alpha, which is the specific upside of the individual companies, then again, unless you've got years of experience to leverage here, highly recommend you leverage others' years of experience. And you can do that a number of ways, but the two, I think, best ones are one, either if you're a DIY guy and you really want to be DIY, then look over the shoulder of a professional that does nothing but analyze this space and knows all the management teams and has dirt on their boots from having gone out and doing mine tours and stuff like that. And there are people out there who do that. And Rick Rule is a good example of that. Jeff Clark, who I have on this program from time to time, he's an example of that. So subscribe to one of their newsletters, their services, and literally look over their shoulder as they make their trades. That's one way to do it. The other way is to work with an advisor like you, Jonathan, who has decades of experience of investing in this space. You really research the companies. I referenced earlier kind of your Buffett-esque approach, and somebody who is building a very intentional portfolio of very specific, well-run companies for very specific reasons, and is monitoring that portfolio. So in case something changes, you're making the adjustments to the portfolio there yourself. So do you agree with what I just said there?
Absolutely. Absolutely. And as I mentioned, I'll tell you also, if you look at, Van Eck in the United States, of course, they've got some really good experience in the gold and precious metal space. Sprott, which I have a lot of respect for. They will create these ETFs, and they'll try to give you as much of that return as possible by ferreting out the companies that they think are riskier and say focusing on the top 15 or 20 silver miners. And they do the balance sheet analysis. They look at the geographical areas, and they do all of those fundamental analysis. So they're screening out a lot of companies for you, and then you're getting a basket, and you will get a substantial portion of the upside without the downside. What typically can happen, we see this in the retail market, people just jump on it, they hear something, someone tells them they made money in a stock, they buy it just because of that. They don't know what's happening. And silver might go to $100, might go up to a couple $100, might go up to $300 or $400, and they buy something that's dead in the water and they don't make any money. And so you do not want to get into that situation. And retail investors often will, because they'll just be totally speculating and not understanding what they're buying. As Warren Buffett says, the less you know, the more you should diversify. The more you know, the less you need to diversify. And so be very careful. I think the ETFs, looking at other professionals, as you mentioned, Rick Rule, and other individuals like that, look at some of the top holdings in some of the portfolios that some of the professionals are running. If they have, a silver portfolio and they have 2 or 3 of the holdings that tend to be 10% of the fund, that's probably a conviction stock. And you might do some research and look at why they own it, and then get into a position like that. So there's ways that you can do due diligence effectively.
So super important points. And folks, really, I think if you're looking to invest in the mining space and you don't have a lot of experience to leverage, highly recommend you talk to a financial advisor like Jonathan and his firm that is well experienced in this, and they'll just answer your questions. I mean, they'll just give you their advice, and you can take it and do whatever you want with it. But get an experienced professional's advice who sits down with you, learns about your specific situation, and then goes from there. And, like really big questions beyond just, what should I invest in? Are questions like, how much of my portfolio should I have exposed to this sector, right? And again, if you're not really well experienced in this space, you want to get that kind of guidance from an outside expert. So let me just, as a case study here, Jonathan, let me ask you about a specific company. So, you said, hey, you think the biggest opportunity right now may be in the quality miners, and in specifically, you think the silver miners could do really well. There aren't a lot of pure play silver mining companies, as you know, because silver predominantly is a byproduct of mining other metals. So one of the largest, maybe the largest, but one of the largest pure play silver mining companies is First Majestic. And that stock has not performed that well over the past bunch of years. It's been a disappointing stock. It has kind of come back to life a bit this year, but just looking at silver's breakout over the past couple of trading days, stock hasn't really done that much. Now it's got Keith Neumeyer running it, who everybody refers to as one of the best mining CEOs around. They seem to have some really good deposits. Do you have any idea of what's keeping that? Is this an example of the type of stock you're talking about, or is this a company that's poised to pop?
That's a great question. And I've watched First Majestic for a number of years. I've been at conferences where Keith has spoken. He's a long-term professional in the industry, but he's had disappointing results over time also, and he's had a few missteps along the way. And I think that investors are very skeptical, and so that's why I don't think the stock has been moving as much. He's also got some gold exposure in the business now also, but I think that could be an opportunity. I mean, Keith is seasoned. He's got some great assets. And if the price of silver goes to $50, $60, $70, $80, he is going to mint money. And so even though he's had a few missteps and some difficulties over the last number of years, and that sort of maybe put a damper on the stock and people a little bit more negative and more skeptical, I think that skepticism can disappear very quickly if you start to add $10, $15, $20, $30 onto the price of silver. People will all of a sudden, I think, say, Keith's a genius again, and they will pound back into that stock. So I think there is a lot of upside in First Majestic. We don't currently own it, but I am watching the stock, and I am noticing what you're noticing, that it really hasn't gone very far. I think people, again, as I say, are skeptical, but he's got great deposits, and when he can turn them on also, he's had to sort of slow down a little bit when he's had cash crunch. And he's been very careful. So when money starts rolling in, that allows them to expand and do all sorts of wonderful things. So, and Keith is seasoned. He knows his stuff, and he's a very smart investor.
Okay, and this is kind of interesting in the sense there are layers to investing, folks. Obviously, who's got the most promising projects and what's happening with the price of the metals and stuff. But then there's also sort of the psychology of it too, which is, and I'm not saying this is the case with First Majestic, you'll want to get the advice of one of these analysts I mentioned earlier, or a firm like Jonathan's that's taken a deep dive look at the company, where sometimes a reputation gets developed that may not actually it may no longer apply to reality on the ground. And so if there's a company that's sort of fallen out of favor but actually has really good fundamentals, you might be able to get in at a discount before the street wakes up to the fact that, oh, we've been undervaluing this thing all along. This ugly duckling is now a swan, and we all want part of it.
Exactly. I think that's exactly the case. And so if you can find companies that they actually do have great assets, it's just that maybe there's been a difficulties emerged, temporary political issue, something like that, displaces the business for a few quarters. And people therefore just look elsewhere. But the underlying asset is strong, and with increasing prices, they're going to produce a lot more of that product, and they're going to make a lot more money. So I think that there are opportunities in that area. I mean, GROY, Gold Royalty, which we talked about briefly, that was a company again that we owned through Abitibi Royalties. It was a royalty company up here in Canada around the Malartic property, which is Agnico Eagle, and Yamana at the time, which is all Agnico Eagle now. And then they were bought out. We made good money on our Abitibi deal, and they were bought out by Gold Royalty. But Gold Royalty did a couple other acquisitions, and it sort of fell out of favor, and the stock dropped literally about 75%. It was trading at half net asset value, despite having some of the best royalty properties in the world. And no one cared because they were 2-3 years away from substantial cash flows. And so, you looked at it and you go, this thing's not making any money. But then you look at the royalties and the parties that are developing the royalties, and you couldn't buy a better package. Our concern was it was going to get bought out, that Franco was poking around some of the other larger players, and they would love to own that business. And we were hoping that it wouldn't disappear so we could get the capital growth. But there's an example. It just fell completely off the radar screen. And a lot of your guests have talked about index investing also. And so people are just pounding their money into indexes, and if the gold and silver companies aren't in very many indexes, and people are not buying the precious metals indexes, there's not much capital going into these businesses, and so they do nothing. They just go sideways. But if you're patient, eventually the cash flow will get picked up, and people will price the securities based upon the cash. And then if greed sets in, as we've talked about, it can just take off like a rocket. And I think that we are seeing some of that right now. And the global macro situation and the monetary conditions are only adding gasoline to this situation at a rapid rate. I mean, they're just pouring gas on this.
Okay. So commensurate with everything that we're talking about, there are very high valuations placed on the rest of the equity markets, right? So we have an AI, stock boom still going on. A lot of debate right now whether it's a bubble, and we even have some pretty prominent people in the AI space, no less than Sam Altman, saying, "Hey, it's a bubble." So I want to take another quote, same fellow here. When the stock market is in a secular decline, that's when the gold miners will really fly. This year's been good, but it's nothing compared to what's coming. So curious to hear your thoughts on that. So, I get it in the sense that, like, hey, if we've got all this capital that's, been getting shoved into other parts of the market, we've had folks talk about how, I don't know, close to 40 cents of every dollar that gets put into the market through the whole passive investing process gets put into basically 7 or 10 stocks. Right, pretty much none of that's going into the precious metal space. So if capital starts saying, "Hey, look, we're not being treated as well as we were over here, so let's go where we're better treated, and we'll go into the mining sector." Yeah, I could totally see that sending prices much higher, as you and I have already talked about. But we've also seen cycles where the market has been very richly valued, and it's gone through a material correction, and kind of as it's going through the correction, everything gets pulled down in that vortex, right? Especially if it's a sharp correction with margin calls and stuff like that. So curious your reaction to what this guy just said. You feel like, yeah, as the rest of the market cools off, in general, we're going to do great, or be careful?
Be careful. That what the gentleman has pointed out is could certainly take place, and that is a viable path that we could see. People start to panic out of one area, or it's a bubble. They start to pull money, and then they look for other areas, and that could certainly push the miners and some of the commodity businesses up. I do think that as we saw in 08, 09, if it's really dramatic drop, then I think you're just going to have to hang on, that people will sell what they can sell. They'll seek liquidity at any cost, and they'll get out of things. And that can also take down gold and silver. We saw that in 08, 09, but then we saw a quick rebound. And so again, if you're an investor, you've got to be careful. You got to know why you own them. And you can't get spooked out of positions if the fundamentals are supporting those businesses and the valuations are there. If you can get spooked out that easily, then you're really not an investor. You're a speculator. Mm-hmm. I do think that the valuations, clearly because of AI, are extended. I mean, I'm not telling you anything that is really all that intelligent. I mean, when you're trading at just 40, 50 times sales and things like this, and of course that's not sustainable. No one knows when that'll come off. But for professional investors like us, we can't chase those kind of stocks like a Palantir or something like that. I mean, again, an amazing company and so forth, but it's just, we just can't pay those kind of multiples. But with AI, with digitization, with robotics, all of these long-term trends, they are requiring a mining revolution. I mean, they all require dramatic digging of holes in the extraction of nickel, copper, silver, all sorts of resources, right? And you're going to need uranium to, power the, the AI facilities and so forth. And so I think that along with the concern over fiat currency and purchasing power, there could quite likely be a good commodities boom and opportunities there. And so we're trying our best to sort of handpick businesses and selectively get exposure to areas that will benefit from that. Also, I think Stephanie Pomboy was talking about that recently on your program, and I agree 100%. That's where we would rather find businesses trading at 1/10 the multiples with similar growth prospects in some cases, and we think we can make more money and protect our investors' capital better.
Okay, let me pull this question here from Steve. He asks for your thoughts on investing in Mexico silver miners and politics. But if you have anything to say about that, please do. But let me expand the question here, which is with commodity companies in general, certainly with precious metals producers, you have country risk, because a lot of these operators operate in countries outside of the US and Canada, right? In this new world order where America is, assuming more of an America first way of dealing with the rest of the world. And so, everybody is kind of taking a beat and saying, okay, well, maybe it's a little bit less about we're all, part of one big globalized family. And we're, as Michael Every would say, it's sort of a return to mercantilism. Has country risk re-rated to a higher level in this new world order?
I think so. I think you want to be careful in terms of political risk in different countries. Mexico.
Sorry, let me ask one more question, just so you can wrap it into your answer. Is the risk of nationalization higher now as countries are starting to say, hey, wait a minute, maybe I don't want to just liberally share my country's resources with the rest of the world the way I was doing before?
I think the risk of nationalization, it probably is on the rise. I mean, you've got totalitarian governments, more government centralization of power going on in many, many countries. And so even if they don't outright nationalize it, they can step in and demand royalties, which in effect is an equity position. We've seen some of that negotiation going on in Panama now with the Cobre mine with copper. I mean, eventually I think that'll come back up again. But, Panama will make sure that it gets expropriates a fair bit of the wealth of that. Even in Canada, we've had royalty situations change, and we are basically a country that's pretty favorable for resources. But you start fooling around with the royalty rates, and again, governments are strapped. And so they don't have to necessarily.
Notice Jack just asked, kind of tongue in cheek, like Canada.
Yeah. I mean, Canada's changed royalties on different assets over the years, and basically that's just taking an equity position. They can say, they don't like Donald Trump taking an equity stake in Intel. Well, if you're taking a royalty stream, that's an equity stake basically out of the company. And out of the assets. So I think we do have to watch that. I'm speaking to individuals who know Mexico much better than I do and are investing down there. Some of the folks running the companies there. Mexico is still very close to the U.S. It's very dependent on the U.S. I think nationalizing and just expropriating assets from U.S. investors could be a little tricky. I think they would be careful about that. So I think you're probably safer in Mexico than in many other countries, despite the fact that it has tremendous political problems, and as we know, sections of it's run by drug cartels and so forth. I think you'd have to be careful, and that's probably one reason why you diversify. And even if you're looking at a mining company, be careful about buying just a one-trick pony where they might just have one asset in one country that's risky. If they can have it in a few different places, that can give you some protection to your asset value also. I mean, First Quantum is a good example of that. A well-run company, very well-run company. They put all that money, a good chunk of their money in Panama, over 10 billion US in that Cobre mine, and the next thing you know, it shut down. The company didn't go out of business. They had to raise capital. They worked. They had other assets. They've protected themselves, and they've lived to fight for that asset in the future. So they were able to survive. That might not have happened if they just had that one asset. The things like that you need to look at when you're looking at companies and realize that that's part of the risk profile.
Yeah, and so you're underscoring two really important things. One, you really got to do your homework and due diligence if you're buying individual miners. And as you said earlier, you can really benefit from diversification, whether it's just playing it safe and buying the industry sector ETF and just capturing the beta, or leveraging someone else's portfolio. But again, getting diversification, because no one knows what's going to happen with any individual miner. Let me ask you this. So Joe asks, with the prices going up in gold and silver, when will the small junior miners start to be acquired by the larger ones? Should happen, right? I mean, that tends to be the cycle of the space, right? You talked about how you were afraid that GROY was going to get snapped up by a larger player. So at some point, if this bull market continues, we should expect that, right, Jonathan?
Yes, we should. That is the natural order. I think that as Rick Rule pointed out, in the period, I think it was from 2011 to 2001 to 2008, you had like a quadrupling of the price of gold, and you had the free cash flow per share on gold miners actually go down. And so you had a lot of acquisitions that didn't make any sense and so forth. So I do think that there is a little bit more financial discipline in the market right now. And so those junior acquisitions, I think, will come, but they'll probably be the better companies. And I think there will be a lot more scrutiny in terms of especially the early transactions of what's taking place. We've seen some transactions already going on. I mean, some silver companies have disappeared. Assets have been bartered amongst companies, like the Porcupine property bought by Discovery Silver and so forth off of Newmont. So there are transactions going on. I think that will continue. But again, I think they're going to be very careful. So if you are looking to buy a company where you think it might get acquired, make sure, again, it's got great assets in a good spot where they can be developed by putting more capital into it and expertise. So you can really develop the production level of the gold or silver. That's what companies are going to be interested in buying. But I think, again, it might be a little slower this time around, but it will speed up eventually. If money is to be made, it'll take place. M&A activity, that's inevitable eventually, especially if silver keeps going up and gold keeps going up, there'll be more M&A activity.
Right. And I've also heard Rick talk about how a lot of the, major producers sort of slowed down their CapEx over the past decade. The point being that they just sort of have, either less gold in the ground or less projects in development. uh, looking out forward than they have in past eras. And so at some point, they're going to need to go on an acquisition spree to start making up for that deficit in CapEx. Is that something you've seen too?
Yeah, absolutely. That is what the experts who follow the area very carefully in terms of it. And the reason why the capital hasn't been invested as much going back a few years again is because the stock prices were low and they were being punished. And if you're a CEO of a company, your stock price is in on the basement floor, and you're trying to preserve your capital, and you don't dare issue any stock, or you're just going to get killed in terms of dilution and so forth. You're just going to be preserving capital and trying to really run a business that is protecting your balance sheet, basically. When the price of gold and silver now have gone up quite a bit, all of a sudden your cash is flowing in, and you're going to have to deploy that. And otherwise, you're not going to grow the business. I mean, the whole game is to take cash this year and put it back into your business at high return on invested capital, so you can compound. You don't compound unless you reinvest. So as the cash flow comes into these businesses, the trick will be reinvestment. And they're, I think, going to be careful this time around, just because of the bad experience they had. But again, over time, that carefulness will go away too, right? If for example, we run another 4 or 5 years of really high prices and money's flowing, people will get reckless again. So be very careful. You want to buy into companies that are not reckless. They're very disciplined. I mean, one company we've been very fortunate to own is Agnico Eagle, and run by Sean Boyd. Now it's a different CEO, but he's been chairman, and that thing is just amazingly disciplined. And you see what happens if you run a disciplined company. The ability to compound and outperform your peers is just massive. And you look at the misallocations at Barrick, for example, just to pick on them. They've gone nowhere. And Agnico Eagle is up, hundreds and hundreds of percent. So it is all about capital allocation, and Rick is quite right. They will be buying resources, and they'll be looking for great resources that they can put their cash to work in, and so I think that will also spur on the sector and get more greed, more interest, and more fear of missing out into the sector.
Yeah, and that FOMO, I recall right after the last big bull run that this space had. An analyst sitting down with me and basically sharing just the data and saying, hey, the buying just got stupid at the end of the cycle, where companies were out there willy-nilly just spending stupid amounts of money to acquire these really junky small explorers. And he said, if you actually look at the stock prices when the mania was really raging, the worse the company's prospects on paper, the better the stock performed. like they just could not get enough speculation. I mean, there's no guarantees it's going to go exactly that way again. But if the bull run continues the way you think it will, do you think we will eventually enter that cycle? And I'm not encouraging people to go intentionally buy junky companies, but where that kind of caution gets thrown to the wind like that by the industry, where it's like we just got to get more of this stuff.
If it goes long enough, we'll be there again, because that's human nature. And we haven't changed anything about human nature. Over time, people will forget all that they learned in the past, and they'll repeat it again. And that I don't believe in a cyclical view of life, but I do believe that things will rhyme with the past, because human nature is the same. So again, we saw, like with the tech situation too, I think we are seeing valuations in some tech stocks. I mean, there's some wonderful tech stocks, but some of the valuations are getting just to ridiculous levels. And we saw that back in 2000. And I lived all through that, the JDS, Uniphase, the Nortels, the Sun Microsystems, on and on they go. And they could do no wrong. And people will pay those valuations. So I think the same thing happens in every sector. If money is being made and things are going up aggressively, and that goes on for a reasonable period of time, then caution gets thrown to the wind, and people jump in with both feet, both hands, and try to grab whatever they can. So yeah, I think that will occur if this goes on for an extended period.
Okay. Well, that's the big if, and Jonathan will be tracking what happens as this goes on, and we'll have you back on to update us as things go on. We might have, I hope we didn't, but we might have top ticked this whole run while we've been talking here. A few minutes ago, probably about 20 minutes ago, silver futures jumped up to like 42.25. They've now dropped back down below 42. They're still close to it. But anyways, we'll see what happens from here. But the story has definitely gotten a lot more interesting since the last couple of times we've talked, Jonathan. And we'll be getting deep into the latest update on this in the not too distant future at Thoughtful Money's Fall Online Conference, which you'll be participating in, Jonathan. So thanks in advance for that. And folks, you'll have a chance to ask more Q&A of Jonathan there too. Specifically, if you have questions about how to invest in this space, you can talk to Jonathan and his team anytime you like. And the easy way to do that is just by filling out the short form here at thoughtfulmoney.com. If you live in Canada, then make sure that there's a very short form to fill out there. You fill out that Canada is your country of residence, and that way you'll be connected directly with Jonathan there and his team. But yeah, I have a lot of Canadians that watch this channel, and from time to time, I get Canadians reaching out to me saying, "Hey, do you have an endorsed advisor in Canada?" And yeah, I just want to say, yeah, we do. We've had for a good while. It's Jonathan and his team. And whether you're super excited about the miners and want to talk to him about that, or whether you're concerned about all the other stocks, the AI stocks and the general markets itself, again, his team can help with that. Or if you just want to talk about, hey, I want to update my financial plan, I want to make sure I'm on track to hit my financial goals in life, retirement, funding, education, whatever, you can talk with this firm about that too. So, Jonathan, I'll let you have the closing words here to folks about anything I either didn't ask you, or just any parting bits of advice you have for folks.
Yeah, one item I just point out is you do have to be prepared for some downstrokes within a bull run. So, if silver drops back to $35 or something like that, or gold drops back to 3,000 or 2,800, again, I'm not predicting that, but you do get these moves within a bull cycle. You want to understand the fundamental reasons why you own these precious metals. And again, it gets back to all of the different folks that you've had on speaking about the challenging, macro situation, the monetary conditions, the trading conditions around the world, the housing market weakness. I mean, watched Melody Wright talk about that and so forth. These are all real economic issues. And it's all of these issues ultimately that are buttressing and supporting the prices and the valuations of gold and silver and so forth as well, especially with silver with the production shortfall given the demand. So don't be scared out of these things. Understand why you're buying into the sector. And if things come off, take advantage of that dollar cost average. If the fundamentals are still supporting it, then there's just going to be greater opportunities. So just be careful. There will be some volatility.
Right. Yeah. And that's, obviously Buffett famously says he loves it when the things that he owns goes down in price, because it means he can buy them at a better deal, as long as he still believes in the main thesis. And I'm glad you brought that up. One, because these are just volatile assets to begin with. I mean, folks, you can't invest in the space, even just the metals themselves, without really appreciating the fact it's very volatile. So you're signing up for a wild ride, especially so if you're investing in the miners here. But Jonathan, we talk a lot in this program about how bear markets have, historically had some of the biggest rallies in history, right? And they're kind of designed to suck people in, thinking that the bear market's over, and then the bear claws come back out and destroy everybody that just jumped back into the pool. Is it somewhat similar in a bull market run where you have these drawdowns and they, their kind of goal is to get the weak hands out, but then it's back off to the races. So you want to make sure you're mentally prepared not to get shaken loose.
Absolutely. Absolutely. That is exactly what happens. People will get shaken out very easily. They want to buy high and sell low. It's retail investors overall, and professionals too. We have to be very careful as professionals. But retail investors, I mean, the studies have been done. They can be in an asset class that goes up 10% a year over 10 years, and they can lose money in it. because they're buying high and they're selling low. I mean,
Yeah.
that famous study that Fidelity did years ago with Peter Lynch, you know, on the Magellan Fund. I think the Magellan Fund, made an average of, 14% a year or something like that, but the average investor in it made 2%. And you know, it's some crazy things like that. I mean, don't quote me on the exact numbers, but that's directionally what happened. And that's, again, because people get shaken out much too easily because they haven't invested for the right reasons and they don't understand those fundamentals. So again, be very careful about that, or work with. I mean, we're more than glad to work with people. That way we can talk to you and you know, walk you off the ledge and say, this is why you own these stocks. Nothing has changed. The federal government's still running these massive deficits. You know, Europe is in a funk. You know, Japan's got major challenges. China's got issues. These issues haven't gone away, and so fiat currency is under pressure, and that's why you want to own the precious metals for the foreseeable future.
All right. Well, very well said, my friend. Again, folks, just a quick reminder. Jonathan will be speaking with a lot of other phenomenal faculty at the upcoming Thoughtful Money Fall Online Conference. That's Saturday, October 18th. Don't worry if you can't watch live that day, because everybody who registers will be sent replay videos of the full event, all the presentations, all the live Q&A. You won't miss a thing. So to sign up now and lock in the early bird price discount, which is the lowest price we're offering, go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, make sure you check your emails that I've sent you. In them is a code that you can use to get an additional $50 off of that lowest early bird price. I want to make sure everybody who can gets the lowest price they can. All right, Jonathan, this has been great. Folks, do Jonathan a favor, let him know in the live chat there in the comment section below how much you've enjoyed him being here today, and to show him that, hit the like button and then click the subscribe button below, as well as that little bell icon right next to it. And obviously, if you want to go talk to him and his firm, or one of the other financial advisors that Thoughtful Money endorses if you live in the US, just fill out the short form there at Thoughtful Money. Jonathan, my friend, great to see you again. Great job today. Have fun riding this ride. I'm sure there's going to be some curveballs, some twists and turns. I've got confidence that you're going to navigate that just fine for your clients. But as you know, we get more highly interesting developments here, love to have you come back on the channel to elucidate them for us.
Yeah, I love speaking with you, Adam. You do a fantastic job, and the channel's very instructive for me also as a professional. I love to listen to the different guests, and more recently, some of the guests have been outstanding in terms of the value-added information. So just encourage all of the listeners and to take advantage of it. This is amazing information.
That's very kind of you to say, and it's an honor to hear that you watch it to educate yourself. But yeah, we landed a really big guy just fairly recently. We got Jonathan Wellum on the program. Amazing.
Thank you very much, Adam.
All right. You take care, Jonathan. Everybody else, thanks so much for watching.